Welcome back to Pass the Balance Sheet, the show where we pull back the curtain on the financial side of running a business and have the conversations most people avoid. In today's conversation, we are getting into two terms that show up on your financials every single month: depreciation and amortization. Most business owners see them, most business owners nod along, and almost nobody can actually explain what they mean or why they matter. So today, we're fixing that. Let's dig in. Happy Wednesday.
Greetings. Greetings, my friend. It's been a while.
It has.
How has month end been going? How
It's always good. Those first, 10 to 15 days are always such a blur, and then it each month is kind of like a season in and of itself. So the
Yes.
first, 10 days, you're just, in a whirlwind of a tornado, and I feel like I'm probably a person that no one wants to be around, and then the second 10 days, you're, starting to come out of the storm. It's kinda like the call I don't know, the calm after the storm, but
Mhm.
there's still, things flying around or tumbling down the road, just tying up those last little things, and then you have the last 10 days where you can really just, take a real, woo-saw, and, we're
Mhm.
starting to enter, that woo-saw, but I always crack up because I don't know about you, but those first 10 days, it's like a magnet for my clients in, they don't need anything the second or third 10 days, but I started doing month end and it's like, "Hey, Cash, I need this. Hey, Cash, this came up. Hey, Cash, this is an emergency. Hey, Cash, do you think we could have a meeting today?" And I'm just like, the people pleaser and the professional in me is like, "Of course, yes, you help provide a living for me and my family and my kids." And the other side of me is like, "Really? We do this song and dance every single month, and you know that the first 10 days are just miserable." So, it's like
The
this battle in between
it's
internally.
It's so true, and this is it's always the complaint of, I think, every finance department person, because even in with clients where, we'd have a weekly powwow of, like, what we're working on this week and blah, blah, blah. Everybody always forgets that it's month-end close. Like, the finance department is always like, "Okay, it's month-end close, like, so don't bother us." And then, like, everybody else just kinda glosses over it, and they don't really realize what it means for the finance department. So, yes, I am so familiar with that.
Yeah, it's like
Absolutely.
whatever meme you see of, people drowning, that's, what it feels like, and then, they're throwing, lifeboats at you, but they're not even close to reaching you. It just yeah, it cracks me up, and yes, my corporate career was no different, and they come in like, "Hey, Kasha, you're busy?" You just wanna be like you just wanna tell them for real, and you're like, "Nope, nope, not at all."
Oh, Cash, before we jump in, I was catching up on our episodes last night, and I am so embarrassed about something that I completely missed and forgot when you were in town. You mentioned that there was an Italian joint that you wanted to check
Oh
out,
my
and
gosh.
I did not. I made all these
You did
plans that were
amazing.
not, like
You did
oh my
amazing.
god.
That was not our
But everything
first.
but what you wanted.
Oh my gosh, no, please stop.
So what was the
There's
place?
more visits to come, but
Better be
I
good.
don't know, actually didn't tell you this in our pre-show.
Hmm,
I feel like you need to come here in September
okay.
because, the city the St. George Chamber of Commerce, shout out to the St. George Chamber of Commerce. I am actually a member of them, and they're phenomenal. But they host a annual event every year. It's called Rise. I actually think it's Rise St. George. You can find it. There's a
Okay.
whole website.
Mhm.
And last week, I was officially asked to be a presenter. They
Wow.
only do, I think there's 8 presenters. It is a very large event.
Sheesh.
When I was asked, I actually kind of embarrassing. I guess this is really pulling back the curtain and sharing with our listeners that even we deal with imposter syndrome. But when I was asked, I literally what I said was, of all the people in St. George in Utah, like, you feel like I'm your best candidate to, like, fill this last vacancy.
Why would you say
I
that?
just it just kinda fell out, and our like, the CEO and president of our chamber, he's so awesome. I said it once, and, like, most people would be like, "Alright, you got it out, like, move on with yourself," and we're actually on a board together, with the university here in town, serving on a committee, and so that's when he asked me, and then afterwards, he's like, "Hey, Cash, um we'll connect on kind of topic and what would be great for you to present on and what have you." And again, I was like, "Really? Are you sure like I'm the best you could come up with?" And he goes, "Oh, stop it. Oh, stop it." So, I haven't shared with very many people, but I think it would be a great opportunity for you to come out
Yeah.
and visit
Well, I'm
here.
I'm gonna come out and support, absolutely,
Yeah.
but can we, like, quit with the like, we need to have a sesh here of, like, getting your self-worth back up. What is
Yes.
this doubt happening here?
It's so
I don't
funny.
get it.
Well, I hope that all of our listeners hear that even we as successful businesswomen, even we, that have sat in big seats, you still have a level of imposter syndrome. You still fight some of those demons. I have come over the last week to reality that yes, I deserve to be up there speaking with the best of them, and I have things to say that people should hear, and, am now excited about it. I do it's actually not until September, and I do now have, like, um, a full outline put together. So,
Mhm.
um,
Sweet.
we've
I'm so
moved
excited.
kind of out of the imposter syndrome and into the excitement, syndrome, if you if you
Yes.
will. But
Yes.
the Italian restaurant, you picked such great places that I didn't even think twice about it.
Awesome. But what was it? What was the name
I can't
that you
remember.
wanted to
So
check out? Do you remember?
so do you know uh where I think it's the baseball stadium? There's actually I think it's called Tupelo Honey. There's like a little and it's the Italian restaurant right next to it. So I'm pretty sure it's called Tupelo. And they're known for their cornbread, and it's kind of like a
Oh, in Denver, yeah?
yeah.
This is in
And
Denver.
so
Okay, uh-huh.
that Italian like restaurant bistro is actually like right around the corner from it.
Gotcha, gotcha. Okay, okay. Well, next time we will hit it up, but I am so excited to visit you in September.
Yeah.
Yay.
Yeah.
Awesome.
Get you all the
All
dates.
right. Well, let's dig in.
I am excited. I say this every single time, but I am excited to talk about depreciation and amortization. And one of the reasons I'm excited to talk about this is it is so important to the financials, but it's very rarely fully understood and talked about, and so that's what I'm really excited to kind of dig in and try to bring a little bit of normalcy and understanding around the two, and why leaders, owners, what have you, should be paying attention to these two. So just like a basic foundational distinction between the two. um they are they're similar in the fact that we are um we're expensing out, I guess value would be the best way to say it, but depreciation is tangible. So thinking about things like equipment, vehicles, computers, furniture, and amortization are intangibles like patents, trademarks, software licenses, client lists, maybe non competes. And so, one easy distinction is one is things that you can touch, which is depreciation, and one are things that you cannot, which is amortization. And so both of them show up on both financials, and we'll dig into why that is and when those moves happen as we get into the episode a little bit. more. Is there anything that you think we need to add on that, or are there things that I missed in just those basic kind of descriptions?
No, I think you described it well. I would add to, you said it's a way of kind of spreading out the value. I would add to that value and its usage, and that's kind of
Mhm.
our. Let's kind of dig into why we even spread that cost at all.
Mhm.
So essentially, we let's say we purchase an asset today for 50 grand, and whether we pay it in cash, whether we lease it, whether it doesn't matter kind of how and when you paid it, you have obtained an asset. And the way that the reason you amortize it is because you've it's meant to last a certain life cycle, right? So you bought equipment and it's like, let's say this equipment is meant to last for 15 years. So you're kind of representing on the financials your usage throughout time. You're not going to get its full usage out on day one. So that's why it doesn't make sense to expense it on day one. So essentially what's happening is you're throwing it on your balance sheet as an asset that's producing value to you, but you're amortizing that cost within each period essentially of
Mhm.
that life cycle to represent the true usage. And so this is actually one of the main concepts of that differentiation between cash basis accounting and accrual accounting. Accrual accounting is all about matching to the period. Did you earn these revenues in this period? Did let's coincide those same costs that took to earn those revenues in that same period. And same thing goes with this equipment, or if it's an intangible asset, um, the usage and basically of that item throughout that period.
Yep. Yep, I couldn't agree more. And the life cycle, the thing that I would add to that is the life cycles can be ambiguous, right? So it's kind
Yes.
of
Yes.
it's decided at the purchase and it's decided based on how a company um decides their own useful life. And so some people will look at a vehicle and say that the useful life is 7 years. And some people will say, well, the useful life is 10 years. And when you look at a computer, and I would also add in here that not all things that we mentioned have to have a depreciation schedule. So there are businesses that say, a $600 computer, it has a useful life of, say, 2 to 3 years. I'm not going to depreciate a couple $100 each year. I'm just going to expense the $600 this year and just be done with it. But um, but it is important to note that the useful life is ambiguous, and specific to the business owners. I do think
Yes.
that we should talk about, like, depreciation styles because there are different types of those. We can dig into it later on after we get through some of the meat and potatoes that we talked about. But what I mean by that is, there's straight line depreciation where we say the useful life is 10 years. And over this 10 years, we're going to depreciate equally out over 10 years. There is accelerated depreciation. So again, it is really something that should be decided at purchase time, what the useful life is, what the depreciation or amortization schedule is going to be. And I would, or at least I do within my firm, I would always talk or partner with the CPA on that conversation because this is one of those situations that affects tax liability. And
Mhm.
to kind of bring it real world circle into the conversation with my business, my vehicle is an asset on my business. And when you depreciate out a vehicle, a lot of people say like, "Oh, it's a tax write-off," or like, "Oh, it's a tax deduction," or what have you. But what happens with depreciation in vehicles are you depreciate the value, but when you go to sell that vehicle, you have to realize the gain. So
Mhm.
if I buy the car again for easy math for $50,000 and I determine the useful life to be 5 years, I depreciate, $10,000 each year. At that 5-year mark, I've depreciated out all that I can, again, for easy math. But if I go sell that car for, again, we'll just say 50 grand just to be easy, I now have to realize that gain. And when you go to buy a vehicle, you offset that again. And so this is why having tax professionals involved in those conversations are super important, because while the depreciation is helping you in those 5 years to lower your tax liability, that transaction on a sale and a purchase can really bite you in the butt and offset tax liability where you're now in a situation where you owe because of this. And so it's not as simple as just saying it's a tax deduction or lowering
Yeah,
my tax liability.
you touched on such an important note here, and that's the conversations and keeping in communication with the CPAs, because this is where, again, like, Cash and I have mentioned this in prior episodes. We're not tax people. I mean, we know enough to be dangerous, but we've always partnered up with CPAs who are keeping up with the latest and greatest on the rules. And, the IRS will always, like, yes, you have some control in deciding certain things for your company, but there are also rules dictated by the IRS and certain life terms dictated by the IRS. And I have to say that even though I feel pretty comfortable on even like what needs to be depreciated versus expense, like I even in the last year's tax season got a bunch of questions and corrections from the CPAs on all of this stuff, like outside with like some tree expenses are, oh man, there's so many complicated nuances about like, well, is this extent, is it a fix of something? Is it extending a life even
Mhm,
through a fix? Because to me it was kind of black and white, like, well, this is clearly a fix, but this is going to give it life for this many more
mhm,
years. And but there were things that were kind of gray that I learned, no, really need to be capitalized, and I really
mhm.
didn't understand that until, digging in with the CPAs and having these
Yeah.
conversations. So, it's so to your point, and you touched on such an important point on the gains, if you are like if you're operating with you didn't consult with your CPA and you gave your vehicle a greater life. And so now, like,
Mhm,
that you've sold it and now you have to realize this gain that you might not
mhm.
have to if you if you consulted with your CPA. So just yes, number one rule with depreciation amortization is absolutely keep your CPAs involved and keep them dictating.
Yeah, and I would also add to that, I know you and I have both talked about this before. I don't know why it seems to have been in a lot of my conversations lately outside of the podcast and my normal career conversations, but I have a very firm belief. I know that there are people that don't agree with me. Those people are usually the people that own firms that do both, but your CPA and your day-to-day person, whether it be bookkeeper, controller, CFO, or a combination of, should be two separate people. And if you look at corporate America, if you go look at any of the public companies, you have a chief financial officer who is overseeing financials, and you have a chief accounting officer. And the accounting officer is usually looking at the tax implications, and the finance officer is looking at, long term. And so even in large companies, big corporate companies or even some mid-sized companies, those are two separate people, two separate departments. And so even in small, mid-sized businesses, I believe that those should be two different people as well. We are looking for different things. The finance
Mhm.
side is looking for profitability, while accounting is looking to lower tax liability. And those things need to happen in tandem. You can be profitable and still have low tax liability, and you need to marry well, right? And so um in this we talk about partnering with CPAs. We talk about having those relationships strong, making sure that the relevant parties are involved. But if you have someone that is doing your day-to-day books and they're also doing your taxes, I would strongly suggest you reanalyze that situation. And the second piece to that is that there's dual controls in having two separate people. Um, for my side of things, being in the fractional space, uh, dual controls is everything. It's actually part of our ethos that we try to avoid issuing payments if we're the only person involved in their finance. We will advise on what needs to be paid. We will set some sort of parameters to get things paid, but then the owner or CEO needs to actually initiate those payments. Again, just to ensure that things are happening accurately. So if you don't have two different people, I would strongly suggest that you do.
Yeah, and on that same note of just kind of these different worlds of, uh, accounting and tax planning and having the least tax liability, and then CFO goals of, profitability and expanding the business. Kind of same I don't know, maybe this isn't the best parallel, but I'm trying to transition into just some kind of weirdnesses between what you see on your financials for tax purposes versus like what it means out there in the real world. So maybe terrible example of a parallel, but what I'm trying to say is like, so we're talking about, this concept of amortization and depreciation. So,
Mhm,
like, what happens on the financials when we speak about this is, we purchased this asset, and so it's an asset on our balance sheet. But as we're talking about this depreciation and this kind of expensing it, chipping away, showing its usage, well, what's happening on the P&L, we're showing that usage. It's an expense. It's a 12th of the annual expense that you're writing off. But then the offsetting entry to that, it touches the balance sheet. And so
mhm,
what it means is like it's actually reducing the value of that asset on the books, right? It's reducing its book value. So it's, you're not, when you're looking at your balance sheet and you're looking at your assets, you're not looking at the value that you purchased it.
mhm,
You're basically giving it that paper, that book value of, well, this is what it's now worth, with my usage, with that wear and tear,
mhm,
However, that is still a different, that's great for taxes and all of that. But I've always, hated the way that my balance sheet looked for me personally as a rental owner, right? I'm looking
mhm,
at my looking at my assets. And I'm like, well, they're almost all depreciated. Like I'm worth nothing essentially, but that's not true because in the
mhm,
real world, properties, land is not considered as depreciating or arguable on the
yeah,
appreciating side, but you can't depreciate land,
mhm,
but buildings you do depreciate.
yeah,
But in out there in the real world, if I'm selling my asset, well, no, it has its own value on the market, and so these are two different. Kind of different things that we're looking at and we're talking about, and so it's always kind of bothered me a little bit just looking at the at the value, but it's really just showing it my value with my actual usage, and this is information I will need when I do sell. to your point, there's but to figure out actual capital gains, you
Mhm.
have to look back at the depreciation that you wrote off and all of that stuff. So it really becomes a good like tax tracking thing, but does not necessarily tell you like what your assets are worth in the real world.
Yeah, no, you did a great job on that, and I love that you used the real estate because we both have real estate history and backgrounds, and so for those of you in real estate, one thing that I would say is when you look at your balance sheet, if this is triggering some investigative needs, desires, etc. When you look at your balance sheet, it should show a like a building or uh, uh, some sort of like real property value, and then it usually shows like a land. So the asset is broken out typically into two different line items for the reason that Sassy mentioned exactly to to make it a little bit easier to do that depreciation. One thing I did touch on it a little bit ago, but when you purchase said asset and you determine useful life, and like you said, some things the IRS dictates what that useful life is, and some things are left to be a little bit more ambiguous. And once you decide your depreciation type, if you will, you really should have a depreciation or amortization schedule put in place, because
Mhm.
then you can either create a reoccurring journal entry that happens every month. If you're in QuickBooks, those are very easy to set up and it just automatically does it on that day every month. Or the accountant knows that they need to go in and issue those journal entries every single month and not do a bulk. This is one of my biggest pet peeves, not doing a bulk journal entry at the end of the year. You really want to see that month over month.
Mhm.
I see it very often in interest on liabilities and what have you, that interest is just a forethought. The payment went out, they're recording it all to interest, or sorry, they're recording it all to principal, and then at the end of the year, the balance doesn't reconcile. It's because you didn't increase that liability due to the interest, and so they book all of the interest in December to true it up.
Mhm.
The problem
Mhm.
is then you show no interest January, February, March, April, and it throws off budgeting and forecasting, which we've talked about before, but that schedule really should be created at time of purchase, and you really don't veer from it unless the CPA gives you the blessing.
Yes, and in this schedule should not only be created, but be maintained, and,
Mhm.
I have this is actually a very sweet story of how my husband and I met. We met, reconciling assets of of this one, company where we both worked, and he was working in the data center, and he was, pretty much responsible for all of these circuits and parts and
Mhm.
all of this stuff. And and I was trying to figure out why we're paying so much in business personal property taxes, and basically started this whole reconciliation process of like identifying each asset, like finding it in the building, tagging it,
Mhm.
putting, and then actually being like, okay, some of this stuff needs to be disposed. Like we're keeping it, in our data center, but we're no longer using it. And
Mhm.
so we did this major reconciliation. But what I've learned in that project, other than who my soulmate will be, is essentially like I got the full list of all of our assets, and I sent it to the county of like, hey, here's our actual because this all started with us getting this gigantic property tax bill, the
Mhm.
business personal property tax, and I'm like, what the hell is this? And so it's like, oh well, it's on the what you're using as a business, you have to pay county taxes on it.
Mhm.
And so the what I learned from that project, number one, I got a thank you call from the county person there. thanking me to finally giving clarity on what the heck this business, like what our assets actually are, because they were just like bulked in these like massive categories, and they've been reported that way blindly, like no change, no change every year. And I now finally identified, like, no, like this comprises of these things, these should be nuked, blah blah blah. So they thanked me for, like, thank you for giving us clarity on this. But then what I learned is, like, they have their own life cycles on, like, you might have depreciated a certain thing, but they're like,
Mhm.
"Nope, tax-wise, county tax-wise, we're still taxing you on it." So this
Yep.
is why, like, for so many reasons, it's a good idea to have a schedule that you can be like, "Nope, this is, like, what we actually own. You can't tax us on this because it's actually in the trash can." Like, you know,
Yep.
or
Exactly.
or whatever. So yes, great point. Like, you gotta
And
identify your assets and yeah.
yes, identify them and keeping that list of them. Even so the schedules are important, but keeping a list of what your assets are and when they have been retired.
Yeah.
So often I've come into businesses and the, we've talked about this. The balance sheet is where I go for everything. Like if you have ever met with me or I have ever looked at your business in any fashion, I have looked at your balance sheet first and foremost. This is where I start with month end close. It's where I start with all things. And so the first thing I do is look at a balance sheet and I look at their assets, what is listed there. And if it
Mhm.
is, you can kind of ballpark based on an industry, right? Like if I'm going into a real estate company and they have like $1,000 in assets and be like, huh? Like you just know.
Mhm. Mhm.
You go into, um, I work with a couple uh, auto type businesses. If they have $20,000 in assets, I'm gonna question that because you
Mhm.
have
Mhm.
lifts and toolboxes and what have you. And so that's the first place I start, but I can't tell you how many businesses I've gone into when I ask for the asset list and they either don't have it or it hasn't been updated in so long. And so I'll ask questions like, well, what does this $300,000 compromise? Or what is it composed of? They say,
Mhm.
well, I don't know. And so it is so important that you have an asset list. And the CPAs that maybe listen will probably appreciate this. If you ever get audited, they want to know what you're depreciating out, where you're taking
Mhm.
those credits, if you will. And so it is just so important to keep that list. But um moving in a little bit to I want to transition a little bit to amortization because if you do go
Mhm.
into a business, people know depreciation, right? They know the kind of meaning behind it. Maybe not the full insight they do now if they've listened this far, but amortization is kind of that term that gets thrown out or thrown under the bus and just you don't ever hear about it at all, or you just truly don't understand it. And so I really want to dig in a little bit to amortization. So as I said before, they're intangibles, but they do have value. So again, things like patents, trademarks, software licenses, client lists, non-competes. And so these fairly often get overlooked because most founders, CEOs, um, leaders, they focus on what they can see or what they can touch. And so when you think about a trademark, that is something no one else can replicate. Same with a patent, right? Like you own that.
Yeah.
And there's value in that. If you have a patent on something that you want to produce, you have the rights to that. No one else can build that. There's value in that. But a lot of times those types of things just get overlooked because you can't see it. It's a piece of paper saying that this is what you have. The other reason that this gets really tricky is because it can be very hard to put a value on it. And then it
Yes.
can be hard to figure out how you depreciate it out. So I can't remember if you've been through a transaction in M&A, but part of due diligence is really going through the assets and the liabilities. The stakeholders coming in really want to know what what liability am I possibly taking on and what assets am I bringing in. And they are playing devil's advocate, they're trying to get the best deal possible. Like
Mhm.
that's the goal at the end of the day. They want the lowest number possible. Your sell side wants the highest possible. You're going to meet somewhere in the middle. But so often where these deals get undervalued and the buyers likely get a better deal than maybe they should have are things like the intangibles. And so when we talk about things like client lists, non-competes, the softwares, how do you value those, right? Like if I have a client list coming from the food industry, we had some exclusive clients that we were under NDA with. We couldn't speak about the fact that we were working with them, but we also had exclusivity, meaning that they were only working with us,
Okay.
and that was part of our deal. And
Mhm.
so there's value in that. If someone comes in, they know that that customer can't go anywhere, and so trying to place a value on it can be difficult. And so these do these are assets, like I said, client lists, trademarks, patents, what have you. These are considered assets. They can be, again, you can get as granular with your chart of accounts as you want. You can put them all into their own bucketed asset of like, here's my patent, here's my trademark, here's my client list, or you can have kind of that all encompassing intangibles as long as you have a very good list to go along with it. Um, but these assets are, I just can't stress enough how valuable they are. And if you are going to a transaction, and I see this a lot with service-based customers. So those are, the HVAC companies,
Mhm.
the electricity companies, the I don't know, lawn care, just those service-based businesses that have a client list of people that have worked with them for years. And I see so often that they're selling based on revenue. And there is so much more value to that business than just the revenue alone. They're getting a big book of business. And if you're an HVAC company and another HVAC company is coming to purchase you, they're not purchasing you for your revenue. They already know how to do the deed. They're
Mhm.
purchasing your client list. And so that is why it is so important, from an accounting finance side, to make sure that you really do due diligence in making sure that these non intangible assets are valued somewhere on your balance sheet.
Yes, I want to jump on that train a little bit more. You touched on some really important points here, and number one, the fact that um, it is very hard to place value on these intangible things, and you're very right, like, out of sight, out of mind, we kind of don't think about it, but we absolutely have to think about this during that time of a sale or a merger,
Mhm.
and that's the other point to this is, like, I this takes me back to when I was a treasurer for the nonprofit, and I'm kind of explaining the balance sheet to the founder, and kind of show her balance sheet is very like bare. Pretty much the net worth is what's in the bank account, you know?
Mhm.
And so I'm explaining to her, and I want to put a value of like the recurring donors that we have, like, because I know that, like, yes, like, we have this much in the bank, but we have relationships that we've established, right? We have like donors that are repeat and everything, and I want to put that on the balance sheet, but I can't. They're for both nonprofits and for profit businesses. Um, it's a specific definition, kind of distinction where, like, if you have gained those clients through normal like advertising means, through like operations, basically like what any other business does
Mhm.
to gain their clients. You can't just, capitalize it as an asset. This is the exercise that happens during this, like, well,
Mhm.
I'm going to now sell or I'm going to merge. Now you're putting that value in there. But to your point, like, this is where it's very important to keep very detailed data on, like, well, this is what these clients have gotten me in, the past 10 years. This is what I'm projecting for the next. So keeping that data so you can help build the
Mhm.
value, put that value to it, is so important. So yeah, I just wanted to second that comment.
Mm. So one thing that I do want to that I do want to push on a little bit more or explain a little bit more. I know I mentioned it at the beginning that depreciation and amortization, again, most people are only working with depreciation. So um if you're not using amortization or there's not intangibles, don't feel like you need to just drum them up. But um I mentioned in the beginning that they do show up on both financial statements. So they show up on the balance sheet and they show up on um, the P&L for different reasons. So depreciation and amortization, they show up differently on the P&L than they do on the balance sheet. On the P&L, they are an expense. So depreciation usually tied to physical assets, like I said, equipment, vehicles, buildings. Amortization tied to those intangible softwares, trademarks, patents, etc. So if you buy a $60,000 piece of equipment and you depreciate it over 5 years, the P&L is going to show 12,000 of depreciation expense each year. But on the balance sheet, you're not showing that 1 year expense. You're showing the asset's original cost minus the total depreciation taken over time. And so that total is usually called accumulated depreciation. And so when we're talking about the P&L, you'll usually see depreciation or amortization. And then on the balance sheet, you will see accumulated depreciation or accumulated amortization. And so, the simple way to think about this is the P&L shows what hit, what expense hit that period. And again, this is why that schedule is so important. So often I see that journal entry made at the end of the year, lumping it up for the whole year. But if you're taking that $12,000 example, then you're doing $1,000 each month. You want to show that each month because usually you have quarterlies. And so this can help lower that tax liability for quarterlies throughout the year instead of waiting until the end of the year. While the balance sheet at the end of the year is going to show whatever happened the previous year plus everything that happened this year and it
Mhm.
accumulates over. And so, uh, important to remember that depreciation and amortization reduce profit, but they usually do not mean cash left the bank or the business that month. And I know you have really touched on this in previous episodes when we talk about um, the bank balances in cash. These
Mhm.
are expenses that do not have cash implications. So
Mhm.
I just want to be clear for those that maybe pull their P&L or pull their balance sheet and say like I see it on both. You should see it on both and for different reasons. So hopefully that helps clear up some of the reason why you see it on both.
Yes, you summarized it very well, on the expense side, and the balance sheet showing us basically now the cumulative lowered value of the asset due to the accumulated depreciation. So great job there. And you just made me kind of remember one other important point that I want to mention about. Um, I guess the funny money concept of depreciation, because to your point, this money left ages ago, right? And so
Mhm,
we're just depreciate. So this is not connected to cash. We know this, but there's we can't discount it altogether just because we paid cash for it, 5 years ago. It doesn't, and because it is funny money, it's this like weird line item on the P&L. It's important not to forget about it in general, and
mhm,
here's why. Like one thing that kind of I'm sure frustrates you too as an accountant, but like with I do understand for EBITDA purposes, all of these funny money things are taken out because it's the taxes might be only pertinent to this
mhm,
owner, might change with ownership, so we take that out. We take the non-cash things out of it, but the part that bothers me about it is like we then just forget about this very expensive item that will have to be that it's not just because it's been paid for doesn't mean that it's gonna then you'll never have to use it again. So essentially, like what I really love about one of my clients in insulation is he's so good about like understanding the true costs and doing
mhm,
cost accounting and figuring out like the true production costs with
mhm,
labor and also with like equipment and stuff like that. So just because we are using equipment that we are not like forking out cash for, we still have to we still have to remember it and include it as a cost in our production costs and look at that funny money depreciation expense as a legitimate thing of like this cost went into my cogs. And so this client is like just so stellar about this. He actually like has journal entries that show like part of cogs, the
mhm,
depreciation part, because he wants to see the true margins, like because your equipment, it might be leased, it might be owned, it might be blah blah blah, but it doesn't, just because you're not paying for it right now, it doesn't mean that it was free. And so you have to remember that cost. I guess that's the other side of like, yeah, it's a tax write-off and everything, but
mhm.
it's an expense that you shouldn't forget happened at a
Yeah.
certain point.
No, I agree. I agree. I think we should probably get ready to land the plane. One thing that I do want to mention is, I talked about some ambiguity at the beginning with useful life um and things like that. There's also ambiguity in what do I expense versus what is truly an asset. And while while there is some ambiguity, there does need to be a fine line. And so in my business, and this is different for every business, but in my business, that's $1,000. Anything over $1,000, we really take a hard look at, is this an asset and should it actually be on the balance sheet or should it be expensed out? And so I mentioned the computers, those are very real
Mhm.
expenses that I forked out last year, and they were $600 computers. For me, I felt like it was not worth the time and
Mhm.
energy to take the depreciation over
Yep.
the years. Because
Mhm.
again, computers useful life about 2 to 3 years. $600 when you start dividing that by three, that's $200 a year. You start dividing that by 12, it's a couple. It's a what couple tens of dollars a month, that is more work and journal entries than it's
Yes.
actually going to produce in tax liability reduction. And so
Yeah.
for me, I chose to take that $600 per computer as an expense in
Mhm.
the first year. However, we still do list them as assets within our asset sheet. So we know
Mhm.
who has
Mhm.
them, we know where they're
Yep.
at, we know their value, and then we
Yep.
can also retire them appropriately and know that we
Mhm.
disposed of them in the way that they need to be disposed of. Um, all that to say that I still make purchases over $1,000 that will never have any business being on the balance sheet, but you kind of
Mhm.
find that line in the sand of where do I say this is an asset and where do I say this is just the depreciation I'm going to get out of it is not worth the time it's going to take to actually make those entries. So,
Yeah.
um, do want to clarify that, but I also do want to clarify that you should talk with your CPA, you should talk with whoever is doing your books about ensuring that these assets that truly are depreciation and amortization, uh, that they qualify for those, that they truly are going on the balance sheet and not getting expensed out. Um, it's a huge mistake that I see all the time. So, I think that
Indeed.
those are all the things that I wanted to touch on. Did we touch on everything that you wanted to touch on that you think is important?
I think for round 1, yes.
Okay.
Absolutely.
Okay. What we need a question today. Do you have the
We do.
question?
I do have a
Okay.
question.
Okay.
All right. This has been You'll probably find my questions so annoying because my husband finds them annoying sometimes, um, because sometimes they can be hard. But this one I've been asking myself since like high school, and my answer hasn't changed. So I'm very curious. So you have to tell me. Okay, so this is do or die, and this is why my husband, like, hates this. He's like, "Come on." So you don't have a choice over this. You have to
Okay.
pick one or the other.
Okay.
Um, would you, um would you rather live with no sight or no hearing? Do or die.
What kind of morbid question is that? Um, I think that I would rather live with no hearing because I I listen to so much music and podcasts, so it would really suck. But I I want to be careful how I word this. I feel like I could still live the life that I want to live while being deaf versus being visually impaired. I feel like the things that I love to do, like golfing, like hiking,
Mm,
like being active um and what have you,
yeah.
I wouldn't be able to do those. I don't feel like I could do those
Mhm.
being blind. Still would
Yep.
not be the quality of life I would want, but I feel like I could still live a life that I would enjoy and be proud of if
Yep.
I was deaf versus blind.
Yeah, and
But
that makes Yep.
to that caveat, you're gonna laugh at this. I am legally blind in my left eye. So I have been for my whole life. If you found pictures of me, I used to hate my mom for this, and my mom actually does listen to this, so she will laugh at this. When I was in, oh shoot, it was probably like kindergarten, first grade. I actually had to wear a patch over my right eye to try to
Mm.
strengthen my left eye. And literally, the patch looks like a bandage, like just a brown blob. And even in kindergarten, I used to hate my life. And my mom would be like, let's put a sticker on it. That will be so fun. And I'm like, listen, lady, there's nothing fun about a friggin' patch on your eye. So we're going to put Hello Kitty on it or My Little Pony. And all of a sudden, this is better. And I hate it. I hated it. And so I would like at
God.
the beginning of school, I'd like very carefully like peel it off and put it wherever so that I could very carefully put it back on at the end of the year or the end of the day. And then when I was, I think 8, I had um reconstructive muscle surgery because it was also a lazy eye.
Oh,
And so I
shit.
had reconstructive muscle surgery that brought it back in alignment. When I get super tired, you can actually see it like veer um, to where it's not supposed to be. But even to this day, if I cover my right eye, I'm basically visually impaired. So,
Oh my god. Okay, so a few things. So, number 1, like, we have so many things in common, lazy eye included. Same
yes.
here. But, like, I'm not I don't think I'm legally blind, but, like, probably close to it. I'm, like, 400 something,
Yeah.
and my like, it's insane. Like, I seriously cannot if I take this off, like,
Mhm.
you're like a blurb. You're
Yep.
just like a dark spot,
Yep. Yep.
So, like, I yeah, absolutely can't see, glasses are like a lifesaver, and I only got glasses in, like, ninth grade.
Mhm.
I was always squinting, and then, like, when I got them, I'm like, "Holy crap, like, I've been missing out on the world." Like, I started seeing, like, the different, like, carpet, like, little things of the carpet, or, like,
Mhm.
remember we don't have those anymore, but, like, the popcorn ceiling things, like, all these details that I'm like that all of this stuff was around me, but I was totally
It's
blind
like a
to.
whole new
But
world.
it is a whole new world indeed. But but my answer is, it's actually the opposite because I
Really?
am so used to, like, being blind in the world.
You feel like you can
That
function.
I've learned to function, but, like, the true reason is, for me, it's music, and it's specifically, like, being able to witness my favorite band, Tool. Like,
Mhm.
and this was the same exact answer back in the day. Like, I can't imagine a day waking up where Maynard's sultry,
Mhm.
serenades are are not
Yep.
in my ears, and Adam Jones's screechy guitar licks are not in my ears, and,
Mhm.
the bass is in my blood, in my
Yeah.
veins, and the drum is my heart is pounding
Yeah.
to Danny Carey's drum beat. So, like, I Tool is my life. Like, Tool has been the soundtrack to my life. I can't even though, like, I can hear and, like, would be able to, like, try to sing and, in my head,
Mhm.
the different instruments and the vocals and everything. Like, I need to feel it with my whole body.
Yeah.
So, yeah, so I for me, it's,
It's
I would
so
rather be blind.
funny. It's so no, it's so funny, like, how much we take for granted, like, just in general, in all of our senses, because I pick visual because I do live a very active life, and I just can't picture giving those things up. But I also find myself, like, yesterday I was in my office I work from home most days. I was in my office working, and I could hear my kids just, like, giggling and, being kids. Or like you said, like, there's just things that you can't unhear, and you just don't you
Mhm.
like, you take it for granted. The things you smell, the
Yeah.
things you just it's just
Mhm.
if you have all of your senses, you should be grateful for them.
Yeah. Thank your lucky stars for sure.
Yeah.
And on that note,
Alright. Well, hopefully you guys found something super useful out of this, and I know that depreciation and amortization will not be this won't be the last time we talk about it, especially as we dig into some hotter topics down the road. So, thank you so much for sticking with us this far, and we'll see you next time.
if there's one takeaway from today, it is this: your financials are only useful if they're actually reflecting reality. Depreciation and amortization are part of that reality, whether you've been paying attention to them or not. So take a look at your numbers this week. If something doesn't make sense, don't ignore it, dig into it. And if this episode helped bring some clarity, take a second to like, comment, or subscribe. Those small actions keep these conversations relevant and get this in front of more business owners who need it. And don't forget to share it with someone who has been trying to make sense of their financials. We'll see you next time. Pass the balance sheet.